Let's get back to our panel of guests. Rob Kemp, Director at the Economist Corporate Network, and of course our current affairs commentator, Mr. Gao Zhikai. Mr. Gao, I'm going to start with you. We talked about currency reforms. A lot of investors are worried about what China's doing with the yuan. So what message is President Xi going to send?
Well, I would say if you look at the movement of the yuan against the dollar, it has come down from $1 to 8.3 yuan a few years ago to right now about $1 to 6 yuan. And recently, it is true that the renminbi has depreciated, but it's by a very small percentage point. I would say that the Chinese government has also made it very clear that the stability of the yuan in terms of its exchange rate against the dollar is more or less to be assured. And there is no attempt or intention at all to devaluate the yuan as a weapon in terms of increasing Chinese export to the rest of the world. So I would say we need to take it on its face value and also hope that the yuan eventually will stabilize. And also in the medium and longer term, I think the possibility of yuan strengthening against the dollar is there, mainly because the Chinese economic growth is still and is expected to remain much higher than the growth rate in the United States, and the fundamentals in the Chinese economy still remain strong.
Rob, the other big market moving factor these days, of course, is about the US Fed raising rates. So how does the Chinese currency play into US monetary policy and also its economy?
Well, it's a combination of the yuan-dollar exchange rate and other emerging market exchange rates that the Fed has, it seems, delayed its decision on raising the rate, which it will do. I can, if once one wants a prediction, it will raise the rate. It has to. But it's delayed that in deference to the current situation with the yuan and other emerging market currencies. If it were to raise the rate now, it would create more havoc in the currency markets, and it's not something that's good for the U.S. economy overall.
And Mr. Gao, we've heard about the likelihood of a breakthrough in the bilateral investment treaty at these talks. Is that what you're hearing too?
Well, I hope this will be achieved as a major breakthrough in President Xi Jinping's visit to the United States. Currently, the bilateral trade is above $500 billion US. If we have the BIT, the trade volume between China and the United States can easily double. And also, I think the structure of the trade can be more balanced. Right now, China has a huge surplus versus the American deficit. Eventually, I hope China will be a major importer of crude oil and natural gas from the United States. The U.S. is taking steps necessary to allow it to export crude oil. LNG is already allowed under the U.S. law. And also, if the U.S. plays it right, China can import a lot of high-tech products from the United States. So the challenge is not only
not that it necessarily wants it to, but
the challenge is not only to further increase the bilateral trade and allow more investments in each other's country, but also to achieve a more balanced trade between China and the United States. That BIT will help to play a very important role in this regard.
Rob, I've also heard that the BIT is being likened to a second accession to the WTO, where external competition is invited in to force reforms in various sectors where there's resistance to reforms. Do you agree?
Well, it can, but the WTO itself was a bit of a stillbirth, right? I mean, it was great. It was, look, for China it was great. For the world economy it was also very good. No denying that. However, for example, financial services were supposed to have been opened up through the WTO.
Backwards.
Well, yeah, I mean, you don't exactly see the SOEs competing against Citibank and Chase and these others. And so hopefully the BIT will take it a step further. China would benefit in the way you just mentioned if it could free up the markets to allow more competition that's better for the economy, it's better for consumers, and it's better for the resilience and competitiveness of China Inc.
Yeah, those state-owned companies, for sure.
The state-owned companies that survive, or the private companies and the entrepreneurs that have to then meet global competition. That's definitely good for China's long-term prospects.
Okay, thank you so much for your time.
Thank you.
Our esteemed panel of China experts, China watchers, Rob Kemp, Director at the Economist Corporate Network, and our current affairs commentator, Mr. Gao Zhikai.